Are you a Canadian small business owner grappling with the decision of how to pay yourself, wondering whether dividends or salaries are the better choice? You're not alone. This is a common dilemma faced by entrepreneurs across the country. In this video, we'll dive into the advantages and disadvantages of both dividends and salaries, helping you determine the best strategy for your financial situation. Hi. I'm Fabio Campanella, co-founder of the Campanella Group, where we specialize in crafting integrated financial solutions in tax, investment, and estate planning, specifically tailored for high-income earning Canadians and small business owners. Today, I'll be sharing insights into the age-old debate, salaries versus dividends, for Canadian small business owners. We hope our perspective adds value to your financial journey. If so, please support us by subscribing, liking this video, and sharing your thoughts in the comments below. Let's start by understanding what a dividend is, especially in the context of a Canadian-controlled private corporation, or CCPC. Simply put, dividends are distributions of a company's profits to its shareholders. In a CCPC, these dividends are paid out of the profits that have already been taxed at the corporate level. They come in two forms: eligible and non-eligible, which are taxed differently in the hands of the recipient. Eligible dividends are paid out of a pool of capital that was taxed at the general corporate rate. Non-eligible dividends are paid out of a pool of capital that was not taxed at the general corporate rate. For example, the pool of capital taxed at the small business deduction rate. Dividends get reported on a T5 slip on an annual basis. Next, let's talk about salaries, or what's often termed as bonuses for business owners. In this scenario, you're essentially an employee of your own company. A salary from your CCPC is treated as employment income and is deductible by the corporation, meaning it can reduce the company's taxable income. Salaries and bonuses are reported on a T4 slip on an annual basis. Moving on to the pros and cons of opting for dividends. Pros. Dividends can be more tax efficient since they're taxed at a lower rate compared to salaries. This is especially true for eligible dividends. They don't require CPP, Canada Pension Plan contributions, which can mean savings for both you and your corporation. They give you flexibility in timing. You can choose when to take a dividend and how much, allowing you to postpone personal compensation payments into a taxation period that may be more advantageous. What about the cons? Dividends don't count as earned income for RRSP contribution room purposes, potentially derailing your retirement planning. Dividends also don't trigger CPP contributions, which can lower or eliminate your CPP received in retirement. Although dividends are more tax efficient at the personal level, the combination of corporate and personal tax may not lead to perfect integration, depending on the province of residence, the type of corporate income earned, and the marginal tax rate of the individual, potentially leading to a higher overall tax burden. Dividends do not require tax remittances and can often lead to surprising personal tax obligations in April when personal taxes are due. So what about salaries? Salaries lead to perfect integration of personal and corporate taxes, so there's no surprises with your overall integrated tax rate. Salaries will trigger RRSP room, which can help with retirement planning whether or not you use the RRSP room immediately or in the future. Salaries will trigger CPP payments, which will lead to future CPP retirement benefits. Salaries can be declared as a bonus at your corporate year-end, allowing you to take an immediate corporate tax deduction while pushing the actual recognition of the personal income into a subsequent tax year. And now for the cons. Salaries often require additional cash flow in the form of CPP payments, which in 2023 can reach levels exceeding $7,500. Salaries are not as flexible as dividends in their administration. Salaries require withholding taxes to be remitted on a quarterly or monthly basis. Penalties on late remitted withholdings can be punishing. So what's the overall conclusion? It depends. At the Campanella Group, our personal preference is to have our small business owners take a regular monthly salary and remit regular monthly amounts to the CRA. We find that this treatment helps our self-employed clients set and stick to a personal budget and leads to more streamlined personal financial management. In addition, we find that our clients appreciate the CPP and RRSPs in retirement. We do use dividends to plan for additional distributions and income deferral in many of our retirement planning situations. But for everyday compensation, our preference is salary. Choosing between dividends and salary for a Canadian small business owner comes down to your financial goals. Dividends offer flexibility, while salaries provide RRSP and CPP benefits. At the Campanella Group, we guide small business owners in finding the right balance. We lean towards a mix of stable salary and strategic dividends for overall financial health. Need personalized advice? Schedule a free consultation with us. Visit our website or click the link below. And don't forget to subscribe for more insights. Thanks for watching.